Today, a truly historic moment. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news. It's Friday afternoon and Tarric Brooker is with me. Hi Tarric.
G'day Martin, how are you my friend?
I'm pretty good actually, a lot going on and slowly putting the studio together, although I'm still short of a big hole through the wall to be able to fix the rest of the studio up. So we are still on steam power at the moment.
I'm sure we'll make do, mate. We have for a while now, and we've got plenty to talk about anyway, so I don't think the viewers will miss it too much.
No, exactly. Well, it sort of works, doesn't it, the way we do it? And of course, it's a really interesting time at the moment with bond rates going through the roof and all sorts of other things. But why don't we start with some of the questions that we didn't get to last time, because we had lots and lots of people throwing lots of stuff at us and we ran out of time.
Yes, we did, and let us not be said that we are men of our words, so we'll get right into it. Two Ducks asks, curious to know how bank economists flag serious risk of recession, yet various portals, say like Domain and REA, forecast property prices to increase even in the regions where supply is stronger.
Well, yes. So forecasters, economists, they're not actually very accurate or very good at the minute, right? So just remember, everybody, folks, at the beginning of the year, the economists were forecasting recessions in the US, recessions pretty much everywhere. Okay, Germany's in recession at the moment, but so far, not so much. And the other question, of course, is to what extent does the property market actually connect with the broader market? And I always think that the property spruikers and the property portals have their own agenda and their own view of the world, which isn't necessarily economically that well informed.
Yeah, for me, I think it comes back to an old debate that your mate John Adams had with Christopher Joy. I think it may have been on Sky News, and this was prior to COVID, so a long while ago now. And Christopher Joy said, if we have a recession, all bets are off when it comes to the property market in terms of it, going down. And I concur with Christopher Joy's assessment there. It's if we see a proper recession, one where unemployment rises significantly, where you have a proper downturn, not like the one during COVID where they threw $500 billion at the economy, then yeah, I think it's going to be very, very difficult for the property market to perform in such a positive way because, well, I'm not really seeing much precedent for that. I mean, even if we just say, for example, we leave out the high household debt, we leave out all the issues that are sort of, shall we say, isolated to the current economic cycle, and we look back to say like the 80s or the 1990s. Even back then, you saw a stagnation in property prices that lasted for somewhere between 5 and 7 years, depending on the capital city in question. So 5 or 7 years when inflation is running at that level, that's as good as falls, really. And to be completely honest with you, in the current paradigm of loss-making investors compared with investors who were overwhelmingly making positive net returns back in those days, especially as rates fell, it's a very, very different kettle of fish.
Spot on. And the kettle of fish you're talking about is, I think, a very important one to understand, insofar that the whole story, of course, is very much one of lags, right? What we know is that it's taking a long time for the interest rates and everything else to flow through and the impact to hit. And so quite often I think what we're going to see is a lot of pressure yet to be built. And what I mean by that is that the impact of interest rates for many people aren't still hitting. And we've still got a proportion of people, as we've said before, who are actually relatively well positioned in terms of their finances. But if unemployment rises, then all bets are off. And delinquencies are already rising. And of course, not many people are actually recognizing this yet. And delinquencies, as reported in the mortgage-backed securities, is actually the cream of the crop. So you could assume, I think, that some of the other pressures are there. Now, okay, we can say, well, migration is strong and, everybody's wanting to put some of the money they've still got into property. But I think we are going to see that disconnect come back in line. But I'd also make the point in the US, of course, we've just had strong results. Housing is still very strong over there. So I think this is going to take a bit longer to play out. But your view also, I think, is in line with mine, that actually this could be a 5 to 7 year drag on property if, in fact, things go pear-shaped.
Yeah, I think it'd be good for you to whack up that chart of the residential mortgage-backed securities arrears, but when it's done by the year of mortgage origination. I'm pretty sure you saw that on Twitter a few weeks ago, and it's just really interesting watching the mortgages that were originated in 2022 just absolutely soar into arrears, even though you would think that most of those people would be some of the best prepared because they would have had some forewarning that rates were going higher. But, it hasn't really turned out like that.
Spot on. Remember that a lot of people, of course, got massively overcommitted over the last 2 or 3 years. I'd also make the point that if you look at it across the states, you've still got delinquencies in the Western Australian area from 2014, 2015. So some of the older loans are still struggling with delinquency there, and that's because there was a massive run up there too. So it's way more complicated, and I actually think that many of the portal economists really don't get some of the more nuances, more significant nuances that we're talking about here, and that's why I think ultimately property prices will turn over. Just make it take longer. Remember that my worst case scenario is still a significant fall in property prices if in fact rates continue to rise, unemployment rises, and everything else. If we go into recession, and property is fundamentally overvalued by about 40% relative to long-term trends, so there's still significant downside risk. Chances of moving up from this point is, I think, really, really low now. We're way above the bubble level, so more downside risk than upside opportunity in property at the moment.
It's interesting. Did you happen to see those comments from the Pepper Money spokesperson recently in the AFR?
Just briefly.
Yeah, because basically what they said is that they're like, a lot of people were singling them out for their level of arrears, which is approaching, from memory, about 5%. Now, obviously, they're a non-bank lender. They're some of the riskiest end of the spectrum. But they made a very interesting comment in which they said that our arrears are basically, to sort of sum it up in a sentence, real because we count people who are in hardship provisions while other people don't. Now, I don't know who that particular comment is directed at, but I think that raises some rather interesting questions that people like Lindsay David have raised in the past, and yourself and John Adams, about, well, what do the arrears actually look like across the spectrum at all these various organizations and lenders, that may not be reporting them as we perhaps would think they are in headline terms?
Well, that's a very good question. Of course, it's normally 30-day and 90-day past due. In other words, a payment missed. But you can shape that if you actually have an agreement with the customer that they don't have to pay for 6 months or something, or you've moved into some other arrangement, right? That puts them out of the bucket that would call them delinquent. So there's a really interesting question about what you define as delinquent and how you actually come to it. Now, of course, I look at cash flow, which is an earlier sign before delinquency hits, and the cash flow pressure has gone through the roof. I have a feeling that some of the other information that some of the banks are presenting is, well, packaged in a particular way to present a particular story that they know exactly what's going on and there's no issues. But just remember that we've got some extend and pretend, we've got loans being extended out over 40 years, you've got some interest only coming through, you've got some 1% buffer stuff coming in as well. So there are lots of things that they're doing to try and actually put loans back in the bucket of not non-compliant, which means that they don't have to report them as delinquent.
Yeah, I think that's a really important point that you make, just in the sense that there are all of these extraordinary measures that are being taken that simply just weren't there during, the last big property cycle in, the late 1980s, early 1990s. Because, if you had have said back then, oh, I'm really stressed, I'm having a hard time, can you put my loan on pause for 3 months or 6 months? They would have just told you to get stuffed. Whereas, I'm hearing some anecdotes of people just saying, I'm having a hard time, can you pause my loan repayments for a while and, amortize that into a longer loan or into slightly higher repayments. And the banks are saying, yeah, sure. So it's it's very different to the backdrop, for example, of say the US financial crisis, housing crash, because back then there were a lot less forgiving of people in difficulty.
Spot on. That's exactly right. Well, the banks don't want to necessarily, surface a lot of this pain, because what would they do if they had 100,000 of their customers all delinquent at the same time? They can't foreclose on all of those people at the same time. As somebody once said a few years ago, if one person defaults on the loan, that's down to the individual. But if a lot of people default at the same time, that's a bank problem, right? And it's actually a financial stability problem. So it is behoven of APRA and the banks to find wriggle room around this so that they can actually say that things are not as bad as they might actually be. The problem is, at some point, truth will out, right? If people genuinely are having difficulty making those repayments and are really struggling, the exit path up to this point has been, well, sell the property, get out, and pay the bank. Now, there is some of that going on at the moment. We are seeing some forced sales. There was a report this last week that more forced sales were coming through, particularly from those people who'd actually bought in the last 2 or 3 years. So some people are choosing to get out while they can. But at some point, that music's going to stop, particularly if prices start to slide. So to my mind, we're at the very early stages of truth dawning. But the old extend and pretend mantra is alive and well.
It is, and I think it's just worth noting that the Australian property market is in some ways more vulnerable to that kind of shock than, say, for example, the US during the financial crisis. Now, that might seem weird considering just what Martin and I said earlier, but the difference is that in Australia, housing turnover has already collapsed. It's already down to around about 4.5% of properties being turned over in any given year, which is very, very low. So let's say hypothetically that 1% of mortgage holders get into trouble. Now, there are around about 6 million mortgaged households in it, 6 million mortgaged properties in Australia. So that's about 60,000. Now, if you were to bring 60,000 properties to market, that is going to cause the overall turnover level to surge significantly, because obviously if you're selling a property under those conditions, it's more price insensitive than it would be otherwise. And that's enough to tip the balance of the market completely in the other direction. I mean, we've seen even just the surge from migration, and obviously most migrants aren't buying, and even just the impact as well from more people who are renting being compelled to buy, that holding up the market in a fairly sizable fashion. I mean, all we've got to do is look across the Tasman to New Zealand to see what the market would look like without the various government support mechanisms like negative gearing and the high level of net overseas migration.
Yeah, well, New Zealand's prices continue to go down, of course, and some significant pressures there on households and on property. And I agree that the chance we are going to see some of this come to Australia. But I also think that there'll be a lot of policy levers pulled to try and actually obscure what's really going on and to keep pumping that property. And remember, 700,000 migrants over 2 years is going to provide some demand. And the other thing, of course, with the recent discussion about social housing, where Albo is basically going to buy property from builders. They've already built the properties, and then it'll translate into social housing for a period of time. I mean, that's another lever, right? So there are plenty of levers out there, but the question at the end of the day is, can you keep juggling all the plates, or will it ultimately come back to reality? And I have a feeling that it may. But as with all of these things, it'll take longer than people think. And the downside risk is pretty strong now. I come back to my cash flows analysis, stress analysis, and many more households than ever are actually in difficulty. So I think this is going to play out not positively for housing. And, there are spookers out there talking about low supply supporting prices. But as you say, it doesn't need much to move the dial to be able to increase supply at a time when people don't actually necessarily want to buy property. So watch this space.
Indeed, and just a little side note, just you gave me a little bit of an idea. If all these people find themselves in serious trouble, it makes me wonder, and you just said that Albo's buying properties for social housing. I could see a world in which Albo turns around and goes, you know what? All these people, we're going to buy all these properties at the face value of the mortgage, so that we're bailing all these people out, even these people who are in deep in negative equity. Now, could you see that happening? Them buying all those properties and then saying, "Oh, this is social housing. We're spending tens of billions, aren't we? So amazingly fantastic." But it's a move to prop up the property market, even though they're buying assets at for more than what they're actually worth.
Oh, never let it be said that's a likely scenario. It certainly could well be. Plus, of course, there's always the good bank, good property, bad property strategy, where effectively the Reserve Bank could acquire properties that are actually underwater, etc., etc. So, I mean, there are levers that could be pulled to rescue the property market. And of course, the issue is that the banks are so leveraged to property in Australia, much more than almost anywhere else, so that essentially it becomes a financial stability question and issue and risk. So you could argue that some of those strategies, as well as being dressed up as social housing and policy to protect people, is actually ultimately the agenda is financial stability and protecting the big banks.
Yeah, financial stability. And well, next question. Woodross asks, do you have any data on withdrawals from super due to hardship?
Yeah, it's interesting. There is some data, but not much data. And the data that I'm seeing doesn't suggest to me that many people are withdrawing from superannuation at the moment, but it has upticked a little. I don't know whether you've got any more recent data than I've seen, Tarek.
No, no, I don't. I don't, unfortunately. But I'm wondering if this particular issue is being masked instead of people going to the super option, which I have no doubt they'll do when we arrive at that particular juncture. I'm wondering if instead it's being covered up with equity, mate.
Well, I think it is to a point, and I've highlighted before, and we've shared information about the significant number of people who are refinancing and pulling more equity out. The interesting change here is the buffers. So NAB's now come up and said they're going to reduce the buffer for some types of households. CBA's already done it, others have done it too. But what they're doing there is not allowing people to draw more equity out. So if you want to go with the lower serviceability buffer, you can't do equity mate. But there are still other people in my surveys running the equity mate route because prices are still relatively high from where they were previously. So that is the preferred route, I think, at the moment. The other point there, of course, is that superannuation withdrawals are actually quite complex, and you've actually got to go through a hardship program and process. They do report data, but it's very lagged. And certainly all my analysis from the household survey end of it says not many people are doing it at the moment, but maybe later. Or maybe they did it previously and they haven't got any super left.
Well, that's a factor too. Exactly. That's a really good point. A question from Thumb, who asks, if interest rates are consistently raised and maintained at a higher level, how are property prices going to continue to boom, and how are people going to buy things that they can't afford? In a word, they can't.
Well, that's right. So the real challenge, of course, affordability relative to income has gone, adverse, very adverse, stupid. And if you look at the in international comparisons, our debt to income ratios at sort of 8-16 in some cases, or way higher. In the UK here, people get worried at 4 times, 5 times income. In Australia, I'm still seeing households who are actually at 8 times, 9 times, 10 times income. And that can't go on. I mean, by definition, if incomes are not growing in real terms, the only leverage point then is the multiples that banks are prepared to lend at, which goes right back to the financial stability discussion we just had. Banks were very pleased to lend at high multiples, and their argument was, well, prices always go up, so we are actually unprotected. And of course that's the point. So the banks may be protected because of value growth if it goes up further from this point, but of course borrowers may not be. I mean, it goes back to the big Ponzi scheme, right? It is the biggest Ponzi scheme in town.
Yeah, I think that it ultimately comes down to time. Like people can take the higher interest rates for a while. They can burn through their buffers, they can borrow, they can do whatever it is that they need to do in order to keep paying the loan. But if the property prices aren't rising, they can't equity mate their way out of trouble. And, say, for example, if we were hypothetically sitting here in 3 years, say 3 years' time, and rates were still somehow north of 4%, we wouldn't be looking at the same scenario because things would break, people would lose their properties. Well, more likely they would be compelled to sell their properties, and we'd see a very, very different economy in front of us. So I think that that's what it really comes down to at this point. Like, we don't need higher rates to break the property market. They're more than high enough to send it south. But the question is how long are they going to stay high before we end up seeing the RBA do a panic turnaround and send rates lower in order to save what is basically the main driver of the consumer economy.
Well, higher for longer, of course, is the current mantra. Look at bond rates at the moment. And the fact is, of course, going back to what Phil Lowe said, no interest rate rises till 2024. Right now they're saying, well, rates will be higher until the end of 2024 or maybe longer. The markets are thinking longer than that, which, as you say, there's a longevity question. And I see that in my cash flow analysis. So, households early on were saying, yeah, it's bad, but rates will come down, so we'll be able to hunker down. So they, work their way through that and cut back and put more on credit cards and use their savings. But if the runway gets a lot longer, that momentum dies, and at some point you can't take off. And that's what I suspect we're beginning to see now, that the realization is dawning that this is actually not just a blip. This is actually a significant move. And, just to give people a bit of a sense, we've got bond rates now higher than they've been almost all the way through this century so far. Look at the US 2-year bond, for example. I mean, we are in very, very much higher rate territory than we expected. Now, Tarric, you're right. The central banks could turn turtle and panic and drop rates again, create more inflation, of course, if they do that. But on the other hand, if they don't do that, what's the choice? So they're caught now. They're caught between, the inflation and the high interest rates.
Yeah, no, exactly. I think that we're going to see that continue to play out for, at least the next 12 months because, core inflation is not going to come down quickly. And I think the thing is, in the coming, let's call it, say, the next 6 or 9 months, I think we're going to start to see the flow through of wage inflation starting to feed into broader inflation in the US and in Europe. I think we've probably already seen that in the UK, where wages took off a bit earlier as a result of, well, the UK's serious problems with inflationary issues. But I think we're going to start to see that more so in Europe and in the US as well, because the US has now seen several months of positive real wages growth, and you're starting to see that feed into consumer consumption and even to some degree consumer confidence. So I think we're going to see this uptick again in inflationary pressures after the conclusion of these various base effects. And, obviously the various ends of inflationary pressure. Say, for example, you're going to see the US shelter inflation continue to fall until it finally bottoms, and then it'll start rising again.
Well, I think the base effects you just mentioned is really critical to understand, right? Because we had a year plus ago significant rises in inflation, but they're now dropping out. The trouble is that the new month's inflation data is actually not necessarily as low as people were expecting, and we've got new waves of inflation. So some of those wage driven, some of those in Australia power driven, as well as insurance costs. So there's new inflationary pressures beginning to come through. So I was reading something overnight that there's more and more people now saying we've got another wave of inflation coming through, so we might be coming down to a little bit of a lower level, but it's coming back up again, and that means that this inflationary battle, we're only in phase 1 and there's another few phases to go yet.
Yeah, I mean, that really is the nightmare scenario. That's the thing that keeps Phil Lowe, well, if he ends up keeping his job, that's the thing that keeps central bankers awake at night. They worry that they are going to be like the Bank of England. I wrote an article about this on Substack a couple of weeks ago. I'll include the link in the description. And basically, it just sort of theorizes that given Australia's baked-in inflationary pressures in terms of, as you mentioned, household energy and with rents, a large proportion of the total RBA rate RBA inflation floor of 2% is already consumed by those items that make up less than 9% of the CPI. So it's going to be interesting.
Absolutely. Well, this inflationary battle, I think, is definitely got a long way to run. And of course, there's a bit of a debate as to, the consequences of that, because it's not equally spread as we've discussed previously. But unless they change their settings, and everybody in central bank land is saying we've got to fix inflation, it's our number one, number two, number three, as it were. So the political and economic consequences of that's quite interesting. But if it goes on, how long can we actually live with these rates? Just remember, folks, we're now getting back to rates at normal levels, right? So this is normal. This is not abnormal, right? So we got rates now where they were for many years before the ultra low rates that we saw from 2007 onwards. So are we back to a new normal, or is this a new temporary normal? That's really, for me now, the acid question.
Yeah, I mean, like, this is rates at this level are where, people of my grandparents' age paid off mortgages in the 60s and the early 70s and even the late 1950s, and they paid them off in 4 years, 5 years time, because rates were very much very similar to where they are today, but obviously housing prices were a lot lower. But we should probably get on to the rest of the questions. Olena asks, in the event of a prolonged global recession, which part of Australia, which state do you think will do the best economically, and which labour market will weather the storm the best?
Do you want to have a go at that first?
Sure. I think that the Northern Territory economy is now very much based on LNG. And there's also the potential for, if things really start to get hairy on a global basis, there's it's entirely possible that we could see a permanent US military presence flow into the Northern Territory. And if that happens, and you see 10, 15,000 US military personnel being based in the Northern Territory in a city that isn't really that much bigger than a collection of suburbs in Sydney or Melbourne, it's going to help the local economy, and it's also going to prop up the housing market, and it would also obviously help in terms of just the broader local economy, employment, etc. And I think that it's going to really just depend on the area you're talking about and the world we're going into, because I think there's going to be parts of Australia that are going to benefit a great deal from the boom in rare earth minerals, in the what I would call the duplication of supply chains, so that Western nations, and particularly the US, can start drawing their raw materials from places other than China, which very much has a monopoly on a lot of these commodities.
Yeah, it is interesting. I mean, if you think about recession, that would put lower demand for resources, right? So particularly, iron ore and things. So that could have a very significant impact on Western Australia, that is predominantly driven very much by what the resources sector is up to. You've got situations where tourism could potentially be turned down because people would have less discretionary spending, and that would perhaps put pressure on some of the Queensland areas where they're actually very reliant on tourism. You've got some other sectors of the economy that are more diverse, so some of the East Coast states perhaps, but a lot of them are still pretty caught up in this. But I would argue that maybe places like Tasmania would really find it very difficult, right? I'm already seeing significant pressure even now in Tasmania, so I'm not sure that WA or Tassie would be the place to look at. But it does depend on the nature and the shape of the recession, and which countries actually fall over. And it does come back to, I think, ultimately, Tarric, what China does, right? If China has a recession, what will China do now? And will they turn the build more stuff lever up, or will they throw the money at households to try and get them to spend more, and then have a very different profile? And that would actually have a significant negative impact on the Australian economy.
Yeah, I completely agree. It's very much going to come down to what China does. I mean, a consumer focused approach, wouldn't necessarily be too bad for some elements of the Chinese economy, so, and which feed into Australia. Say for example, the students and the tourism side of things. That's obviously benefits in that aspect. But yeah, I mean, if China finally stops following this path of construction fueled, and let's call it steel fueled growth in property, in infrastructure, etc., the Australian economy is basically in serious trouble. But I mean, the ironic thing is that Australia isn't actually that bad off in the long run. It would get smashed in the short term as it adjusted to the new paradigm. But the reality is that we have most of the low cost iron ore on the planet right here in our own backyard. So even if you were to see China completely go down the gurgler, eventually Australia would emerge in a monopoly position over most of the world's iron ore once more, and Australia would still stand in a relatively strong position with all these other commodities I mentioned. As you continue to see rising geopolitical tensions. So it's not necessarily a bad thing in the long run. It's just this short term thing that we have to deal with, and in a lot of ways, part of the issue as well for the eastern states, in particular Sydney and Melbourne, is if you see immigration reverse, if you see people start to go home as the unemployment rate rises, as we've seen many times in other economic cycles around the world, well then you've really got a demand problem in those particular local economies.
That's right. Well, it comes back to the demand drivers of the economy, and particularly 60% or so of the economic activity is consumer led, which means people buying stuff. So there are less people with less capacity to spend. That's going to have a significant downdraft. But I do agree that I think long term, strategically, I think Australia is quite well placed, unless of course they end up making the same strategic mistakes as they did with the LNG. So effectively, we've got massive amounts of LNG in Australia, but what have we done? We've actually ended up paying the marginal global price for local energy because of the fact that the LNG strategy was actually completely messed up, and it's being putting huge inflationary pressures on Australia. So there is a strategic question about whether in fact state and federal governments have the capacity to actually manage this appropriately, or whether they will just again roll over and let those big international corporates rule the roost, and we end up in Australia paying the high marginal cost.
So it requires competence from our politicians. That's a scary thought.
Yeah, that is a scary thought, isn't it? Well, so far I give them about 3 out of 10.
I see we're being generous today.
Exactly. Well, it is a Friday. I'm trying to be generous. Competence. Look, just on the LNG, this was called out 4 or 5 years ago. This was not a problem that wasn't being discussed, but the political decisions that were taken by Turnbull and others were actually tactical, pro-business, and frankly inappropriate. So that's how we've ended up where we are, and nobody wants to tackle the true issue, which is that we've ended up, being taken to the cleaners. The energy costs are stupidly high. If you think of Saudi Arabia or other oil-producing states, look at the local cost of oil in those states. Well, we've got the same issue with LNG. Why aren't our LNG prices in Australia the same as the best in the market rather than the worst in the market?
Yeah, well, I mean, let's just hope that it's better managed in the future. Although, to be completely honest with you, as you say, I have doubts, in our 3 out of 10 government.
Okay, I was being generous.
Okay. Well, considering the fact that this next question goes with the charts, I think we should fire that up. Okay, folks, as usual, all the charts are available at avidcom.substack.com. I just want to say thank you to everyone who donated and has sent some kind messages of support. That has been very, very much appreciated. And without further ado, we shall get into the questions and the charts. Now, I had two similar questions from AirPlus369 and Pacific, who both asked about total hours worked and jobless claims. Now, we don't have jobless claims here in Australia, really, because the Centrelink data isn't really that great, to be completely honest with you. And it basically asked, what does total hours worked look like per person over time, both during a recession and now? And what we're seeing now is basically average monthly hours worked is still continuing to rise, which, considering the extremely large growth in the population and also the rising female participation rate, is still a very good sign for the labour market, at least in the short term.
Yeah, but Tarek, one of the things about the average hours worked, you need to reflect on that in the context of the fact that more people have multiple jobs. So, the numbers of hours worked is to do with the fact that more people are having to work more hours by working more jobs just to get by.
That's very true. That's very true. I mean, it means that we've got a relatively decently strong labour market for the moment, but it also means that a lot of other people are in a bad spot. And I think that really just that takes us back to the sort of K-shaped economy that you and I have been discussing now for the best part of 4 years now. Three and a half years now. That there are some people who are doing very, very well and their spending is continuing to support the labour market. And then there's other people at the other end of the spectrum who really aren't doing too well. But I will note that historically, this particular metric rolls over prior to recessions. It rolled over in not 9 months before unemployment started to rise in 1989. And it also rolled over 2 months before we started to see major job losses in 2008. And in both of those instances, the loss of hours per capita was around about 2%. So I think it's going to be an interesting one to watch because it does seem to be a leading indicator for the labour market. But I don't think that we're quite there yet in terms of labour market weakness. It's coming, it's on the horizon. But when exactly it's going to arrive is the over $2 trillion question.
Absolutely. I'll make the other point, Tarek, and that is that if you look at the most recent data, the growth in hours worked has been predominantly part-time female, and specifically in some of the caring professions, which would actually suggest that this is more to do with healthcare and aged care and those sorts of things, and people working more hours, part-time hours particularly. So there is a question about the quality of jobs and the amount that is actually paid to individuals for those hours worked, because of course a lot of those jobs are quite low paid. So we might well see people working harder and working more part-time jobs, but not necessarily dragging home that much more in terms of real income.
Yeah, I think it's also worth noting that at this point, we're seeing a larger and larger proportion of jobs growth coming from the public sector, which is the paradigm that we saw prior to the pandemic. And really, to be completely honest with you, if you look at the data from, say, from late 2018 into 2019, the overwhelming majority of jobs were driven by the public sector at that point. And if not for that, you would have seen the labour market and the economy begin to roll over in a much, much more serious way than we did historically. So it's going to be interesting to see how that's managed, because, I mean, theoretically, the public sector really shouldn't be going on a hiring spree at the moment, because obviously the more jobs they create, the more demand they create, the more inflationary it is, at least on paper. Yet they're doing the complete opposite. They're going out there and they're hiring, a disproportionate number of people relative to the private sector.
Yeah. Although, of course, we might find that some consultants from certain consulting organisations might be jobless quite soon. So maybe there's a countervailing argument there.
Yeah. Well, there is that, and I mean, let's hope that particular issue brings some lasting change. But
Don't hold
I
your
doubt
breath.
it.
Don't hold your
No,
breath.
I'm not holding my breath. I'd be dead 50 times over. All right, next chart. Now, I actually missed this over the last couple of weeks, so I completely forgot about it. But here it is, the Kiwi housing price chart. And this is what a housing market looks like when you take away negative gearing and you don't have record high immigration. It's not pretty, but it's worth noting that Kiwi unemployment is still only 3.6%. No one, that we're not seeing the giant implosion of the economy that people predict when you see housing prices fall to this degree, like capital city housing prices in places like Auckland down almost 25%. So, you know, maybe falling housing prices ain't so bad.
Or maybe it's where they fall from. And it's interesting, Tarek, that chart shows you particularly the comparison with the US, right? So, compared to the US, it's a mere pimple compared with the Kiwi.
Yeah, I really quite like that. And you're actually seeing that little trend is going to continue in the next couple of months as well, because this is when we saw a seasonal bounce in the US housing market, and everyone was like, "Oh, everything's going to be fine," and then obviously it wasn't. And it's also worth noting that this is the US. This isn't from the peak of the US housing market either. This is from the time that the US entered the recession, and this is also and we've also seen at this point this is post Lehman as well. So the fact that the Kiwi housing market is imploding in such a spectacular fashion is really quite something. And I think you're right. I think it is about where prices fall from. I mean, we saw an analysis from CBA a while ago that said that if housing prices fell by 20%, the proportion of households in negative equity, sorry, the proportion of borrowing households in negative equity would still be in relatively low single digits. So I think that's really worth noting, that it really wouldn't be so bad overall.
Well, I've argued for some time that the only way to solve housing in Australia is to get housing to come back to more normal levels, right, from a debt to income ratio and those sorts of things. So the only way to solve housing bubbles is actually to let the bubble go pop. And in a way, Orr in New Zealand is actually engineering a much more stable housing market into the future, right? And he's actually said in a couple of recent comments that we're getting back to the point where housing is more affordable. So there is actually upside to let housing values come back to where they should be. Funny enough, when you take all the stimulus away and when you take away negative gearing and all the other multiple levers, there is a natural value for housing rather than this inflated stupidity that we've had in Australia for the last few years.
No, absolutely. And I mean, next time Albo or anyone says, we've tried nothing and we're all out of ideas on how to address housing affordability, and it's just like, well, just look over there. Look over there. Look at what they've done. You do that, you can have affordable housing. Now, if you want to say that you don't want affordable housing, then just come out and say it. Enough with the bull crap. Just say what you mean. And if you want to say, I want to keep housing prices high, then say that. Alienate the voters, but at least be truthful.
Politicians, truthful, come on.
Well, yeah, well, what can I say? I'm an optimist, Martin.
I'm a realist. They will say and do whatever they do to get the next vote, the next election. I've long walked away from the idea that politicians have our best interests at heart. They have their own interests at heart, and the interests of their political agenda, etc., etc. Unfortunately, BS is cheap. True strategic action is actually what we're missing.
Yeah, I agree, unfortunately. Now, this is what I was referring to earlier and will be in the linked article that I mentioned to Martin. And basically, this is the total cumulative impact of household energy rising by 25%. Now, 20 to 25% was what was penciled in by various energy regulators. And also gas prices have already risen by 25% year on year, and it's set to continue to rise. Now, I've based this on different rental inflation scenarios, the RBA scenario, CoreLogic and SQM, various ranges, but I think it's just worth noting that 69% of the RBA's 2% inflation floor is consumed by the RBA's very benign rental inflation scenario. So this idea that we're going to be cutting rates, at least I should rephrase that we're going to be in a position where the RBA are justified to cut rates by the level of inflation is quite challenging, considering the fact that you're talking about somewhere between 1.4 and 1.9% of the entire CPI stemming from just 8.95% of the CPI basket. So it's going to be pretty difficult to get inflation back to target while these factors are still swimming around. Now, I'm currently working on a little bit of a basic inflation model, but to give a little bit of a preview, things like education inflation and healthcare inflation are only updated very, very relatively rarely. Education is done on an ongoing basis, but the major changes only occur once a year in that. And healthcare, the major changes occur twice a year. So you're looking at baked in inflation in those particular metrics of somewhere between 4.5% and 5.5% that are baked in for the next 6 or 12 months. So it's a fairly sort of sizable level of baked in inflation that's going to make it very, very difficult to get to the lower end of that RBA target to justify being in a position to actually cut interest rates, as all the various, spruiking says that they will.
Yeah, exactly. Well, I mentioned earlier on, the concept that we'll see inflation come down again, but then take up again, is what I'm suggesting. And it's worth just reflecting on this, that some economists remind us that if you want to beat inflation, you need to have an interest rate that is actually above the current inflation rate. Just pause for thought, right? So where is inflation? Where are interest rates? They're actually the wrong way around at the moment. So that would suggest that we need to see interest rates significantly higher if in fact inflation is really going to get crushed. So there's a lot more work to do.
Yeah, and that's the risk. I mean, there are now, it's only I think about last I checked on the rate futures, there's about a 7% chance that the Fed gets to 6%. Now, if the Fed gets to 6%, the RBA is going to be dragged up towards 5. So, it's and not only that, but for the moment, our economy seems to be holding up okay. So we could still see rates dragged significantly higher, especially if for some reason, because I mean, analysts, people in general, don't really understand very well what is actually going on in the US economy at the moment. It has held up a lot longer than a lot of people thought. I think that's eventually gonna blow up in some people's faces as they get overly bullish on it. But it is still holding up, and there is a scenario in which we do see Aussie rates push up towards 5%.
Absolutely. Well, the latest bond market numbers out of the US were much higher than people expected because of the very strong US economy. So, the expectation now is that the Fed will have to do more. In the UK, they're talking about rates of 6 or maybe even 7% now. So I suspect that we're going to see rates in Australia also going higher for longer. And all of this is because this inflation thing is complicated. And of course, you've got second order effects. You've got the wage rises coming through and beginning to have an impact. And I would argue that some of those low wage awards, which were actually needed, is potentially inflationary. There are other things too. So this inflationary journey is definitely not over yet. And I'll also make the other point, Tarric. I'm not sure that if you change the governor, you're going to change the formulation of monetary policy, right? Because all central banks in the Western economies are all on the same trajectory, irrespective of who the governor actually is.
Well, I think that's gonna be an interesting one because we'll see Chalmers make the decision about who's going to be the governor after this September coming up shortly. But I think one of the things that's going to be interesting about that is just what Lowe does with his last 2 rounds. Because if we see him raise both times, then that may, just maybe leave the next governor in a position where they don't have to raise rates anymore. Because, they may think, well, 4.6 is good enough, even if the Fed gets to 6. We're at a record spread between the federal funds rate and the RBA rate, but it's not a new record. It's one that, that we've seen before. And I think it's worth noting that a lot of what is going to play out in terms of interest rates, ironically, doesn't have all that much to do with inflation. I mean, it does at its core, but it's about, say, for example, the Australian dollar. Now, the Australian dollar is in a vulnerable place at the moment, if we see a big risk-off move, particularly one driven by higher bond yields, we're going to see the Australian dollar go lower. It's going to get weaker, especially now that it's being held up by ideals about Chinese stimulus. And if that doesn't eventuate to the point that the market thinks it will, and I don't think that's going to, and I don't think it will eventuate to that point, then the dollar's in a very vulnerable place and may need to be supported by bringing the RBA cash rate closer to the federal funds rate, so you're not seeing that differential put so much downward pressure on the AUD and risk importing all that extra inflation.
Yeah, I think the Aussie dollar is the one to watch because I suspect you're right. That's the way into understanding how inflation ultimately will play out because you can't afford to import too much inflation from the dollar being in the wrong place. Um, so, yeah, I think the next governor, whoever it is, whether it's Low, version 2, or whether it's somebody else, they've got a really tough trajectory ahead because this is not going to shake out quickly. And remember, they're saying inflation is not going to really come back into band for at least a year, 18 months, and they're saying that the interest rates are going to be well above where they were for a long, long time. So this is a long road.
Yeah, I think that's a good way of putting it. Now, there's been a lot of discussion about the ABS monthly inflation figures, and they have been distorted into absolute oblivion by holiday travel costs. Now, holiday travel costs surged by something like 40% in December. So everyone's been using, not everyone, but a lot of people have been using year-to-date numbers because of that, because it means that it just shows this. Of course, that's going to happen. It's seasonal. It happens all the time. The ABS have warned multiple times on this issue. They've said, be careful. They even came out and said, we are now going to have an excluding volatile items category that excludes holiday travel for this reason. Now, this is what inflation on a monthly basis, excluding the volatile items that the ABS take out, looks like. Now, this doesn't look especially like an amazing downtrend to me. It just looks like it just looks like seasonality that you'd see in the Melbourne Institute monthly inflation gauge that has issues with seasonality and the up and down monthly volatility.
Yeah, it's noisy. At the best of times, it's noisy. And the thing about the monthly, I have to say, I was very depressed when I read all of the media coverage, and they were all sort of celebrating the slightly lower number. Look at the core. Look at the core number, right? It's hardly moved. But no. Headline is down. It's all over. But it's based off mythology, right? These monthly seasonal numbers move around all over the place.
Yeah, exactly. And this is the Melbourne Institute monthly inflation gauge.
Mm.
As you can see, it's volatile as. It's always been volatile. It's always going to be volatile. And this is it. And this is on an annual basis. And it's still got the volatility. But I think it's worth. I quite like the Melbourne Institute monthly inflation gauge. I'm not, it has its issues with seasonality. It has its issues, as any monthly index would. And it's true in all of them. You look at all the monthly inflation gauges around the world. None of them are perfect. But I think it's worth noting that if you look at their numbers, inflation peaked lower, which I actually agree with, because you don't have that big, outsized, enormous thing from holiday travel completely screwing everything up. But it also shows how sticky inflation is. And I think that that's really the key point, that even on their trimmed mean metric, inflation isn't really moderating in a meaningful way. I think it may be moderated by 0.1% in the last print.
Yeah, that's the view that I have about inflation, that it's much stickier and it's much more complex than the headline. And like I said, there's more inflation bad news coming through. Look at the rise in energy prices, for example, a few other things too. So, yeah, this game ain't over yet.
No, and I think it's also worth noting that everyone knows rents are surging. Rents are going to continue to surge into the new year. And I think, not only that, they're not even into the new year. They're going to surge probably for the next 2, maybe even 3 years in the CPI, maybe longer. We don't know yet. I mean, even Lowe said that they're going to be high in the CPI for, and I quote, a long time. And one of the issues with that is if rents surge, their weighting in the CPI is going to be raised in 2024 or in late 2023's monthly inflation figures, which is then going to feed into more inflation than the chart I previously showed would suggest. So there's a real mess in that regard because I mean it's also worth noting that the rental weighting for the CPI was reduced for 2023 because apparently rents didn't go up in 2022. So who'd have thunk it, right?
Well, yeah, and that shows you the stupidity of this whole thing, right? So you've got so many underlying changes in the data and weightings and all those things, and then you try and actually extrapolate the whole universe from those rather poor numbers, and then try and make policy off the back of it. No wonder we have a problem.
Yeah, exactly. I mean, if we had real-time rent, tracking of real-time rental growth back in 2021, rates would have had to have been risen by sort of July, August, 2021.
Yeah.
Because everyone would have gone, oh crap, this is huge. This is going to move the CPI. At that point, you'd also seen the ignition in the number in the cost of building a new home, which is one of the largest components of the CPI. And if you had those two large CPI components both rocketing, it would have been game over for keeping rates low, which is probably what should have happened.
Absolutely, they should have moved a lot quicker. That was true, but lags in the data, lags in the methodology. Slowness at the Reserve Bank, plenty of blame to go around, and look where we are now.
Yeah, pretty much, mate. Now, this is of euro-dollar credit growth. Now, euro dollars are, without going into sort of boring levels of minutia, it's basically US dollar denominated debt that it originates outside of the US. So this can be a bank loan, this could be a bond, this can be all manner of different credit instruments. But I think it's really worth noting that US dollar credit to non-US residents, so euro dollar, has gone negative year on year. And I think that that's quite interesting, considering the fact that didn't even happen during the global financial crisis.
Yeah, credit growth is the one to watch. What's interesting about this is there's three factors in play. Obviously, the cost of credit's gone up, so interest rates are higher. Demand for credit has come down, and the third is that the eurozone and the euro dollar, are seen as perhaps a higher risk than previously. So there were some higher risks, higher costs, low demand. And of course, as quantitative tightening continues, liquidity is being reduced, and that means that some people are going to find it quite difficult to be able to get what they need. So I think this is a very important forward indicator, and another reason why recession is on the horizon.
Yeah, no, I concur, and I think it's worth noting as well that in some instances, the euro dollar market is at times a last resort, because it can be difficult to get a large scale loan for a corporate in whatever local currency it is, because maybe perhaps the rates are too high, or perhaps the banks aren't giving the credit, or for any number of different reasons. But if this sort of not quite lender of last resort, but sort of bottom of the barrel option for some corporates is removed, then that makes those recessionary feedback loops more likely.
Well, that's right, and the big picture issue here, Tarric, is we've had 20 years or so of zombie companies being able to support themselves through ultra low credit availability. And what we actually need is a big shakeout of those zombie companies, right? Because effectively it means that capital is not being effectively deployed or used. So there is a very important catch-up phase to come, where many of those companies ultimately do fall over and disappear. That, of course, is the essence of the way that financial markets should work. But we've actually been leaning against that through central bankers and their interventions. So the question is, will they allow that to happen? So will they allow the cleansing to happen, or will they panic and then sort of try and prop everybody up once again?
I think it's going to be a matter of degrees. I think that there will be some losses in that regard, probably some fairly significant ones. But when I think about, the fact that something around about, even in the US, around about 25% of companies are zombie companies. And obviously that's not 25% of the labor force. It would obviously depend, but a sizable proportion of people potentially becoming unemployed in relatively short order, they're going to panic eventually, and they're going to cut rates, and they're going to do all sorts of dumb stuff. And I think that's what leads into my broader thesis of how all this ends up playing out. We will see that moment where crap hits the fan, but eventually things are going to get so painful and so systemically risky that we will see the panic, and we will see a reignition of inflation, because I don't think that people and society is capable of accepting the level of losses that is going to come with this. We should accept it, and we should get on with it, like our parents and our grandparents and everyone in every economic cycle has since the dawn of humankind. But I should rephrase that. People can deal with it. People can deal with pretty much anything. They can deal with the Germans dropping bombs from the sky. They can deal with, being besieged in a city. They can deal with whatever they need to. Humans are extremely resilient. Australians can be extremely resilient. And I have no doubt that we would get through it all, and we would deal with it, and we'd emerge from it better on the other side. But the government doesn't believe that we are going to be able to cope. At the very least, that we're not going to be able to cope to the point where we're going to vote for them or their buddies ever again. So that is going to be what ends up influencing things, especially if it plays out next year in the US in the middle of a presidential election year.
So what you're saying is it's politics first, economics second, then, isn't it?
As always, it's all. That you can read back to some of the accounts of various historians and local statesmen, even in the time of the Roman Empire, where what are you building this for? Do you even need this bridge? Well, no, not really, not really. The army comes through here every now and then, but mostly it's for the local community and for patronage in X, Y, and Z. So, I think that the thing is that government just underestimates people. They underestimated people during COVID. They've underestimated people for decades. People are perfectly capable of dealing with whatever gets thrown at them. Yes, some people are going to suffer, and some people are going to have a hard time, and that happens in every economic cycle. But the reality is people are suffering now. A lot of people are already doing it tough, and I think it's really quite sad that the $71 billion a year loss in purchasing power is overshadowed by the loss of cash which is flowing into the banks due to higher interest rates, which in net terms is significantly lower than that, especially once you start factoring in the fact that the banks have to pay higher deposit rates. So it just gets me that the people who are suffering the most in some ways get the least amount of coverage because they don't have a mortgage.
Yeah, absolutely. Well, it's unequal, right? So it goes right back to what we said about K-curves and those sorts of things, right? So there are some who are actually doing relatively well, some not. But the point is that politicians don't treat us like adults. They treat us like kids, right? And they're doing that because they're worried that we might not vote for them next time. And if we don't receive the candy from them, then we might get cross. So that there is a naivety in the political process which I just find more and more annoying, and I get quite angry about it, because it actually doesn't lead to good long-term outcomes. What it does, it leads to short-term compromises, it leads to short-term messes, and then it leads to significant cover-ups. Look at the Robodebt thing, and how that's all come out, and all of the stupidity that went on there. Well, that's just a microcosm of the way that government works.
I would love to see some details as to how the sort of Politico housing complex works in that regard. You
Yeah,
know,
spot on.
into what drives the decision making, because it isn't. I mean, like, how many different reports do they need from the Productivity Commission? Do they need from any number of government agencies or academic research sources to tell them that their stupid policies don't work, or they don't work in terms of doing what they say they will? Say, for example, uh, you know, first homeowner grants. First homeowner grants do not help all first homeowners. They help a limited number of first homeowners, which boosts up prices, and then people are back where they started. You know, they're not only right back where they started, they're worse off than when they started. Yet they continue to persist in doing them again and again and again and again at a state and federal level, knowing full well what they're doing because they've got reports that are taller than I am, and I'm 6'4", that are right up here telling them that they don't work. So yeah, it's ridiculous. It's ridiculous how, and not only that, but the pretend manages to persist.
Absolutely. And unfortunately, the impact of big business and the way that big business influences some of those decisions too is something else which again is not well understood in Australia. And I think of the power of the banks or the energy companies to be able to actually influence and direct what governments are doing. So I mean, there are a whole bunch of below the waterline questions which should be answered and should be exposed. But the bottom line is that the outcomes don't necessarily benefit ordinary people, which is nuts, really, when you think, well, what is government there for in the first place?
No, I completely agree, and that's one thing that really rubs me the wrong way when people talk about the housing economy and the economy more broadly. Now, and people go, oh, the young people with their iPhones and their Bali and all this other stuff that they buy and their priorities are blah 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 blah. Now, are some people like that? Oh, yeah. I know people who've blown, more money than some of us will earn in a lifetime in that age demographic. But at the end of the day, when you get down to the hard data says that people today in the under 35 age demographic are spending less than they did in 2007 in real terms. They're earning less than they did in 2006 in real terms. And the economy, even prior to COVID, didn't work for large swaths of people. And the reality was is that housing was sucking in so much money and so much capital and so much human ingenuity that the economy was already going into a bad place without anything going wrong, without interest rates having going up. And I think that's really worth keeping in mind as we go forward, because there's this idea of, oh, we just need to get back to how it was before the pandemic. We don't want that. It was crap. We need something different, and we need to get on a path under which all Australians have a shot at, prosperity, at, and improving life and quality of life for everyone, and have that on an upward trajectory, because that's how it has been for the vast majority of Australian history.
Yeah, well, you've never had it so good, to quote somebody, right?
Oh my God, I know. It's like, here's the data. Do I need, what? I'll chisel it on a block and smack you over the head with it until you realize that it's not great.
Yeah.
And I'm just, honestly, mate, I'm tired of just, being dismissed, and of people in my generation being dismissed because we are young, and because we do want a shot at the same kind of life as our parents, because it's stupid. Now, I understand that there are some people out there who are entitled, who are ridiculous, who want everything handed to them, and those people absolutely exist. And I'm not going to be one of these people who's like, oh, all young people, deserve this, and all young people, blah blah blah. That's bullshit. Everyone is different. Everyone has their own drives, their own priorities, etc. But the data says that this is what is happening. So can we please just focus on reals over feels, and stop dismissing people when they raise these issues? Even though I know that's not going to happen, and it's a complete pipe dream.
Well, step one is raising this point of view, and we do this on this channel quite regularly because we think it's really, really important. And there are people who are beginning to wake up, but unfortunately, there are many sheeples who are still still asleep and assume that the politicians have our best interests at heart. Well, I, for one, don't believe that. Right? They have their own best interests at heart, and the data, and kudos to you. You've done some very good work recently showing how that distribution, particularly in the younger generations, has really, really hit people. That data is stunning. And yet it doesn't necessarily translate into effective policy change yet. But, we'll keep preaching the gospel because this is so critical.
I agree. And I mean, the thing is that, I get the stats on my articles, and some of these articles that I put out, that they're read by hundreds and hundreds of thousands of people. So there are people out there who are seeing this, who are getting annoyed, who are getting increasingly frustrated, and we're seeing them on places like there was a great young woman talking about how young people have been left behind on Q&A a few months ago, who was just fantastic, and of course the politicians don't have an answer for them. They because there isn't one. Because if you're shafting someone, you can't turn around and say, "Oh, we're going to do X, Y, and Z to help you," because that's just crap. I mean, even Albo's, we're going to build X number of social housing, and I mean, leaving aside all the various issues that you can't build 30,000 social housing homes for $2 billion, it doesn't work. It's all just so much smoke and mirrors, and I just think that we need to start holding our politicians accountable, and I think that is something that pretty much all of us can agree on, that we should hold Albo accountable, and Dutton, and the Greens, and all of them, because realistically, I mean, as they say, you get the government you deserve.
We elected them. So I agree. I mean, the whole point of accountability is critical. And, in Australia, when you've got to vote, so that means you actually have to make a decision based on, who you actually believe will do the best job. But no, there is almost no accountability, and shame on them, I fear. Yeah, well, Tarric, I mean, so much to talk about. We haven't probably done all the slides, but some really, really important points. And as always, we've taken the data and we've ended up in a philosophical minefield, but a really critical one this week.
Yeah, I think so. I think that it's just important to be able to look at these things, to look at the hard evidence that we have, that we have to hand. And even just for people to be able to look at this data and to watch our discussions and say, yeah, this is what I'm seeing. This is the challenges that I'm facing, and that it's not all just hyperbole and bull and all these other different things that people say to dismiss them. That people are facing very, very serious challenges out there, and if we can help one iota, just confirm that they're seeing what they're seeing, even just for those people, not even for everybody else, that they're not going nuts, that things aren't, as rosy and peachy as other people make them out to be. I think that that's important.
I agree, and just to underscore, the reason we do this stuff is not because we're actually doom mongers and always completely bearish about everything, but there's a really important narrative that isn't being told in the mainstream that needs to be told. And it's based on data, and it's based on an appreciation of the way that things actually work in practice and the dynamics that are driving political outcomes. And that's why this is a really important conversation. And we will do it all again in a couple of weeks, Tarric.
Yeah, well, there'll be plenty more to talk about, plenty more slides, and maybe a few more questions. We'll see how we go.
Great. Thanks very much. Have a wonderful weekend, and we'll look forward to the next one. See you later.
See you later, mate.
Cheers.